The first rates then on your screens, absolutely quiet, just skirting around the 19,350 mark. So pretty much in line with what the pre-open rates, or for that matter, what the GIFT Nifty was also indicating. That's quiet on the Nifty as we speak right now. Let's revisit the big movers first from yesterday. Let's see what L&T is up to after that big 2% move on the stock yesterday. L&T holds up another 0.5% higher, 2,700 on that stock. And I'll just highlight in M&M. So let's check in on what M&M is doing. It's comfortably above that 1545 odd level, 1553 now on M&M. Marginal uptick is what M&M is right now also seeing. Sun Pharma, a trigger-based move perhaps, 1% higher yesterday. Let's see whether the follow-through persists. 1124 on Sun Pharma. There's some bit of green there today as well. Power Grid, Maruti, Hero MotoCorp, these were some of the other large cap performers from yesterday, and they will just come up for you on your screens. Let's see what Piramal Enterprise is up to. Yesterday, of course, the stocks showed big buoyancy, was up about 4.5%. Let's see what it's doing in today's trading session. That stock will just come up here on your screens, down 2.25% as we speak. Like we highlighted, brokerages are saying that, even though the AGM commentary is positive, the stock has already seen a sharp run-up. There's also SJVN, Whirlpool, JK Lakshmi Cement, some of the news-based stocks. SJVN has gapped up 4.6%. Whirlpool will just come off here on your screens next, and then JK Lakshmi Cement as well. That stock is holding higher by about 1% as we speak right now. Indiabulls Housing Finance, and I think we highlighted that, some bit of green on that stock this morning as well. What about the big movers from yesterday? India Cements, BHEL, GNFC. These were also some of the staggered movers yesterday, remember? So they will just also come up for you on your screens next. Gokuldas Exports, they've entered into an agreement to acquire Atraco Group for about $55 million. That stock has gapped up 6% higher as we speak right now. The block deals from yesterday, Zomato, Star Health, let's revisit those stocks as well and what they're up to in trade right now. And Zomato is another 7% higher, 93.15 now. Star Health, 613 on that stock price. NBCC as well, they've got work orders worth about 66 odd crore rupees from the IMA, that's the Indian Medical Association. So that's another stock which is in focus this morning. And then, of course, there's the likes of RCF, NFL as well. Reports say that lack of investor interest has put RCF and NFL OFS on the back burner now. Those stocks are a little mild in trade as we speak right now. And I think another block deal of 11 lakh shares on SJVN, that, of course, is a news-based trigger as well. Kunal, mildly positive start. Where does it head next? And of course, what trades are you punching in?
Yeah, it's an okay start for the indices. This is an expiry week, so the markets would be very busy with the expiry, the nitty-gritties of the expiries. But in terms of the stocks, there are a couple of stocks which I would, in fact, be very keen towards looking for an opening trade. One of them is AB Capital. The stock has come back towards a major support at the 180 odd mark. Looks fairly attractive. And also Tata Chemical, which is also looking very attractive. The stock has confirmed a classical breakout of a 10 to 12 month of consolidation for itself.
All right, Rudra, let's find out what exactly you make of the market open this morning as we're currently skirting around the 19,330 mark. And what would be the first trade that you'll punch in?
See, for me, even a 250 point kind of an up move in Dow Jones is not reflected in our market. Nifty is definitely showing that resistance at around 19,350, 400, having made a false breakout above that levels of around 19,550 and then coming below 19,350. So for me, this market is still a sell on every rise kind of a market. I am not gung-ho. You have to be stock specific, but the momentum on the downside is also missing. That will come only once we close decisively below 19,200 on Nifty, and on Bank Nifty once we make a close below 43,800. Now coming stock specific, India Cement was one buy call which I had recommended. That looks very strong. I want to have both long and short call. So if India Cement is on the long side, I would definitely pick up JSW Steel as a shorting candidate available in future. crucial supports have got broken, and now there is a last support coming to JSW Steel at around 770 to 773 zone. Once we close below 770, JSW Steel is headed towards 745. So I will advocate a sell on JSW Steel at current level. Keep a stop loss of around 790. Look at target of 745 to come on JSW Steel.
Just short of 5 crore shares have traded hands in Jio Financial Services. This continues to see some major amount of trading as well as mutual fund activity. But who better than Milind Karmarkar now to tell us where the market is headed next and what is it that you as an investor should be doing? Let me hand it across to Nikunj for a chat with him.
Hello and welcome to a brand new show of Market Makers, and over the next 30-40 minutes we'll talk about one theme which in a sense has surprised everybody, and that's the comeback post-COVID of the great Indian luxury buyer. The economy has become K-shape, and that in a sense has really impacted the way how the new consumption patterns have got challenged and new patterns which have got emerged. You got one side where two-wheeler sales are not there, but you've got SUVs, luxury watches, luxury travel, luxury fashion brands, everything is on a tear. And my guest is someone who's got a very deep understanding of consumer behavior. He is a marquee investor in terms of identifying mega trends. And I've introduced him before, but I will just do it again for the benefit of our viewers. 20 years ago, he invested into Trent, Titan, some of the franchisees which have become more than 100x in last 20 to 25 years. And that's Milind Karmarkar of Dalal & Broacha. So nice to have you back on ET Now. Thank you for joining us.
Yeah. Thank you for having me.
It's a market where just like we say one shoe does not fit all, I think is at play. Consumption is growing but very selectively and very, very limited.
True.
Do you think this trend is a multi-year trend now? The K-shape what we refer to?
So it's like this, that ultimately it all depends on rising per capita income and where the rising per capita income is. So if it is happening in the middle class, then obviously what you were saying, that or what you have been observing, that SUVs are selling more than two-wheelers. It's precisely because of this that there is more rising per capita income in middle class. So yes, I think this trend will continue for at least few more years.
What has changed for you in last 1 year? Because the stocks and the companies where you've invested in, touchwood, some of them have done extremely well for you.
Yes.
Whether it is Trent, Titan, maybe a combination of some railway names.
Yes.
What has changed for you given that the recent rise in last 6 to 12 months has been almost like a linear one?
So yes, we have added, like last time also I told you, that we are looking at adding some industrials to the portfolio. So overall industrials in our portfolio have moved to about 15%, and they are into railways, they are into power ancillaries, which benefit out of the second generation power reforms. And of course, the others continue to, there is EMS players as well. Those are the new kids on the block, and I think there the opportunity for growth is also significant. So our basic theme remains same, that wherever there is growth, at least visible for next 5 to 10 years, go and invest in those companies.
Okay. Let's pick up railways.
Yeah.
It's a business where it's dependent on government capex.
Absolutely.
It's a business which is completely B2B business.
Yes.
And it's a business where you don't have the best margins.
Right.
Why do you like business? Because the typically places where you've invested in are companies with linear growth and businesses with fat margins.
So when it comes to railways specifically, I 100% agree with you that it's dependent on orders from the government. But there are companies in wagons where significant portion also comes from private sector. And what happens is that once the direct freight corridor is ready, then I do expect a lot of freight to move to railways from roads. And that is where I think the growth will come in. So it will not only be government orders, it will also be private sector orders, especially in wagons, which will drive the sector, especially the segment where, as far as wagons are concerned. As far as Vande Bharat is concerned, again, there is a large opportunity. But I think there, the issue will be that the first Vande Bharat from the private sector will roll only in 26. So one will have to wait for that time. But wagons is something where I think the growth will continue over the coming 2-3 years as well and beyond that.
So you don't think railway stocks or defense stocks right now have reached Humpty Dumpty level?
I don't think so, but at the same time, I think investing at this price, one needs to be cautious.
Okay. When you are increasing your exposure to railways and industrials, are you looking at booking profits somewhere? Because for one stock to get in, one stock has to come out.
Yeah. So we have been moving out of technology. We continue to do that. We trimmed some exposure to our consumption stocks, not because we wanted to, we thought that they were fully priced, but more so because the weightage of some of these stocks went up very high. So that is the reason why we trimmed. And of course, we got out of some of our losses as well, and then moved that money into industrials.
Where did you get out of completely? Where did your investment thesis got challenged?
So in technology, there were 1 or 2 companies where we got out.
That's a call on the cycle or a call on price?
It was a call on, frankly, it was a mistake where we got into at the wrong time, and the stock price simply fell. Okay. So that was one of the reasons why we got out of some of our, or rather one position in technology. We also got out of some real estate stocks where we made money. So because real estate, our view was that it was not in a multi-year bull run. So that is the reason why we got out of that. And as I said, 1 or 2 of our retail stocks, we sold something because the weightage was very high. That's all.
Okay. I'll get into specifics of technology, but I'm going to spend some time understanding a holding which has done very well for you, and that's Trent.
Yeah.
The stock is at a multi-year high.
Yeah.
The stock is now trading at a P multiple of 100 plus.
More than that.
More than 100 plus. Okay. What's the P multiple?
I think it's about, I mean, trailing basis, it would be at about 160.
Okay, 160. History tells us, and it's a global data, that if you're buying stocks at P multiple, even if you're holding stocks at P multiples of 100 plus, the future return for next 3 years is always negative. How would you justify holding Trent at these levels?
So I do believe that if I look at the past 3 years, I think they will continue to grow at anywhere between 30 to 35% year on year, especially because of their growth which they are seeing in Zudio. And I do agree that there are a lot of players who are getting into affordable fashion, but at the same time, I think they have a first mover advantage, and their offerings are pretty good. So they will continue to grow there. The second sort of thought is that it is likely that they may break even in Star Bazaar, which probably doesn't get any valuation as of now. And if they do so, because they have said in their annual general meeting that their focus is to grow Star Bazaar rapidly now. And if that happens, then I think the opportunity there could be also very large.
Let me draw your attention to Asian Paints, Pidilite.
Yeah.
I was looking at data in the morning. From last one year, they've moved into a shadow time-wise correction.
Absolutely.
Everybody talks about it, but last 1 year, the price change in Asian Paints or a Pidilite is flat. Could that be the story for Trent for next couple of years?
So it is not that it hasn't happened in Trent earlier. I think it was between 2012 to 2015, if I'm not mistaken, when it went completely sideways. The issue is that whether you can get in and get out of the stock at the right time, that is, you identify that now it's stagnating, you get out, you get into something else and then do well, or you hold on to the stock and you invest in other growth stocks which will help you to push your portfolio returns. And then the stock which is good or where the opportunity of growth is large, you continue to hold it. So that's what we intend to do.
Where is growth according to you? Where do you think there is visible growth? Let me rephrase that for next 3 to 5 years. Double-digit visible growth for next 3 to 5 years.
So that is in power ancillaries, and that could be in railways. So these are the two sort of sectors where I see more, I mean, double-digit growth in the sense anywhere between 15 to 20% growth.
Okay. Where do you think in the market the growth is visible, but markets are already factoring that in? Which is that what happened to levers, let's say, a couple of years ago.
Absolutely.
It went on, the company was growing, but the stock was not growing. Where do you see this combination where growth visibility will be there, the management will do their bit, but stock markets would say, look, we knew this was coming?
So frankly, you could say that retail is one of them, where already most of the retailing stocks are at a very expensive valuation. So yes, there is growth and significant growth, but at the same time, market is valuing it also more than fully. Probably.
Not in case of railways and power ancillary. You think market's not about
so railways, what has happened, I'll tell you that take for example, again, I always have this disclaimer that it's basically
for discussion purposes.
It's only for discussion purposes and not a recommendation or anything like that. Take for example a stock in metering, power metering.
Okay.
Their order book is currently 10 times their last year's turnover. So and it trades probably at 40 times. Now one would say that 40 times is expensive, and I agree to that. But when you look at the order book which they have, then it may not be very expensive. So that is the thing. So that is the reason why. So whether it's metering, whether it's railways also most of them have 4-5 years order book, and something like, so as I said that in let's say freight, our view is that over a period there will be a shift from road to rail once you have timetabled freight trains coming in, once DFC comes in, and after that there will be a continuous growth in this sector. So 4-5 times order book if you have, I think they are good for at least next 3-4 years.
Okay. Let's divide technology into two parts: the traditional business, the bread and butter business, which is what we understand about technology, the body shop model or the enterprise model. Then there is this AI disruption which is happening. Where do you think Indian IT companies they stand right now? How much is traditional? How much will get hit because of disruption?
So frankly, last few years my view is that Indian IT is a mature business, at least the larger ones. So they will grow at anywhere between 10 to maybe 15%. The ones who are better, or there will be times in between, like we had 2 years back when suddenly the growth came in and then it tapered off again. That will continue to be the case. So it's a good business, but it's a mature business, and it will have to deal with disruptions like AI. So that will have an impact. So they will have to innovate, they will have to get into AI platforms and work on it. But as a business, I think IT is a mature business now, at least the traditional ones. Niche ones will continue to do well.
Do you like anything in the niche space? Have you invested there? Because now there are ultra specialized companies. MapMindia, it is into map.
Yeah.
RateGain, it is helping the hospitality industry. SaaS-based companies are also coming up. Are you looking at something?
We are looking at these companies, but I have not been able to zero in on one single company. We used to hold Tata Elxsi earlier, which we have sold out. We continue to hold Larsen & Toubro Technology Services, which is into engineering services again, not something which is absolutely niche. But yes, I don't think we should call, because we are also holding EMS companies, and I don't think they can be categorized as technology companies, because they manufacture printed circuit boards. But there the opportunity again is large. But as far as software is concerned, again, as I said, that couple of companies in the niche space, and that's all we have. We have about 5% exposure to.
How many stocks do you own right now?
In technology or overall? About 25.
Okay. And are you looking at increasing it or decreasing it?
So probably maintaining it. Let me put it that way.
Okay. I can only think of 3 or 4 pure play EMS companies which are margins of more than 10%. I think Shirma, Keynes, Dixon, Amber, they don't have that high margins.
Yeah.
They are semblers. The EMS stocks have also seen a run up, 2x, 3x ever since they've gone public.
Yes.
Do you think this is the next multi-bagger theme which is at play? Is it like buying IT in 1999, or is it like buying pharma in 2004?
So probably it's like IT in 1999. At least for next 2-3 years, they're likely to do very well. But beyond that, whether it will be the 2000 bust or whether they will continue to do well, only time will tell. But definitely the environment is changing, where we have a lot of OEMs coming into India. We have especially electric vehicles and things like that. And that is the reason why, at least for next 2-3 years, these companies are likely to do well.
You know, you've always championed buying new themes. For example, you bought into consumer 20 years ago. You bought into pharma, I think 2006, 2007. You bought a lot into EMS companies.
Yeah.
Which is the next theme which you are betting on? Because like they say that you catch them young and see them grow.
So EMS could be those companies, but they're young kids on the block.
Okay.
So one will have to nurture them and wait and see how they deliver. Because it's not like a consumer where you had a large population which was expected that the per capita income will go up and things like that. So is it a similar demographic change? I really don't know, because a lot will depend on how much of electronics manufacturing shifts to India, the OEMs. If that happens, then these companies are good for at least next 7-8 years.
Why have you shied away from buying autos? Historically, you've not bought into autos.
So we have Maruti in our portfolio, but besides that, we have never bought into autos because, frankly, again, a business which is cyclical, and most of the times I avoid cyclicals because I always say that I don't understand commodities very well. And these are trades in the sense not 5-6 months, but couple of years trade, you could say, where you could, if you could get it at the right time and sell at the right time, you make decent amount of money.
You know, the idea of market makers, I always keep on telling our viewers, is that we try and bring thoughts which will help you make better investors. And a new learning for me of late has been to understand your investing template, perhaps based on time. So I'm just sharing it with our viewers here. 90% of the market participants in India, they have a time frame of less than 1 year. 5%, I would say, between 1 and 3. And seldom, which is less than 5%, is 3 to 5. Now you would be in the last two categories, 1 and 3 and 5 plus. In the 1 to 3 category or 1 to 3 year category, what fits in for you, and 5 plus, what fits in for you? I may be repetitive with my question, but if you have to classify based on that.
So beyond 5 will, of course, they will continue to be pharmaceuticals, they will continue to be, so anything to do with consumption, frankly, because I think we are at a cusp of growth when it comes to rising per capita income. And from 2,500 to 6,000 could happen in a span of next 7 years. So anything which benefits out of this, because that is almost 2.5 times in 6 years. And if that happens, then all these sectors, whether it's insurance, whether it's finance, whether it's retail, so these are the type of stocks which I would classify under above 5 years. Okay. 3 to 5 could be these railways and EMS players. These would probably come into 3 to 5, and less than 3, of course, there can be many. I wouldn't like to specify which sectors, but rather I can't zero in on certain sectors which are less than 3, but there could be opportunities across.
Less than 1, anything on your radar?
No, no, Nikunj, you know me too well, so definitely
so there's nothing under less than 1 year when you buy?
No, we tried doing that, we failed. So,
but what if you reach your price target?
Sorry?
What if you reach your price target?
So again, price targets are, so there are two, one is the investor and second is the analyst. I have both in me. Analyst typically either revises his target or gives a hold, buy or reduce. Nowadays, sell very rarely people give. So it's a hold, buy or reduce. But for an investor in me, I would continue to hold a stock till its growth prospects start not looking hazy, but are looking mature. So when I say mature, if a company is likely to grow at say less than 12-13%, I would start looking at getting out of that company.
You know, I'm reading this fantastic book from Polak, I'm sure you must have read it, that when we invest in a company, we want to be permanent owners. So you're looking at that kind of a time frame when it comes to some of the consumer names which you own?
That's correct.
Be permanent owners?
That's correct.
Okay. When a stock goes higher, and I'm going to look, let's say Titan as an example, since you've owned it in the past, it has given returns of more than 100x in last 20 years.
Yeah. More than that, actually.
More than that. Yeah, I'm not even adding dividend.
Almost, I think 400 or 500.
400 times, okay. You've created wealth. I will not use the word money here. You've created wealth because you stayed on the course.
Yeah.
But there are market volatility. A 2008 crisis.
Correct.
There would be a 2013 taper tantrum. How do you keep yourself calm? Because these are changes at a global level which may have an impact on the economy, macro consumption patterns, and also the underlying price of the company?
So I typically look at what has happened in the past. You know that well as well, and as long as I believe that nothing has changed much and this is a passing phase, I will continue to hold. And maybe there is a reason for that. That as long as you have your other income, so as long as you are not dependent on income from your investments or trading, then you can continue to hold. Then the current price, probably you should be indifferent. It's only when you are dependent on the current price, then.
Okay, some, pearls of wisdom, if you can call it that, coming in from Milind Karmarkar. Let's just take stock of what the market has been up to as well, and where is it that it's settled down. It has been a quiet start and it's flattened even further. We're now just about skirting around that 19,350 print, pretty much where we left it off in trade yesterday. Tata Chemicals, though, that's your big high flyer this morning, holding up 3.25%. There's Indus Tower, Manappuram, Hindustan Copper, IGL. These are the names which are scaling higher. Look at Piramal Enterprises, though. That stock is a bit of a drag. It's down about almost 3%. The brokerages are liking what the AGM takeaways were, but saying that the stock has already run up a fair bit. So that stock is down about almost 3%. Sun TV, after a mammoth run-up in the stock off late, post its numbers. That enables housing, Bharti, which has had a block deal. All these are laggards in trade. But let's now focus in on Star Health. And let's talk about, all that's going on with the company, and of course the couple of block deals as well which have happened all off late. Nilesh Kamli, the CFO at Star Health, joins in on the show right now. Nilesh, hi, good morning. Good to have you today on ET Now. You've certain funds, Nilesh, which have exited, but you saw healthy buying as well kicking in. Can you highlight for our viewers which are the funds which have fully exited the company?
Good morning. Thank you for having me. To give a background, we were always a professionally managed and private equity driven company. Some of these funds have come in 2016-17, and they are towards the end of their fund life. Fully exited funds are very less. People have been slightly reducing their stakes. So Madison, APIS, ROC, universities which we have on our portfolio, they have exited a part of their holdings.
Okay. None have been complete exits so far?
Yeah, very few stakes are remaining now, but yeah, they are still the shareholders.
Do you anticipate more such exits going forward?
Because it's private equity, there will be some supply which will be there, but we are not bothered. As a management, we are more focused on the business performance. The business has been good, and we continue to do that.
Nilesh, hi, morning. Now, you've hiked prices on your family Ultima. It's been about 3 months. What has been the response? Have you seen strong retention?
Yeah, absolutely. So we had predicted more than 100% retention on the premium side, and on the volume side, we were expecting some 3 to 4% fall-offs. So it is in line with the expectation. In fact, it is better than what we had expected. So that's going on very well.
That's good to know. So in light of that, what is the outlook on your FY24 growth guidance, talking about the volume impact, the price impact? What is it that you're aiming for, and is Q2 as of now on course?
Yes, absolutely. So we have been estimating that we'll go 20% and above in the short term as well as long term, 3 to 5 years. We are well on course to achieve the growth targets. And it's an all-round growth. Our agency vertical, which is our mainstay, we have been recruiting agents. It's going on really well. Digital and banca businesses are doing really well for us. Banca is 50% plus growth. We have 39 partners, both on the PSU banks, private banks, NBFCs. We are firing on all the cylinders. We have been investing in this business for quite some time. So yeah, all-round, well-diversified growth across the channels for us.
All right, good to know. Now, I have to ask, because there's been plenty of chatter around how medical inflation is going to work its way through the system in India. Some say that costs could even double over the next 5 years. Is that a sense that you're getting from what you've heard, and what are estimates really pointing at? What would be the impact thereby on your company?
Yeah, so there is medical inflation more so in the urban cities amongst the listed hospitals. We as a Star Health is a pan-India presence company. We have 35 to 40% in semi-urban rural areas where the impact of inflation is not very high. What we are doing is we are trying to bring in efficiencies in our claims processes. We are negotiating with the hospitals for package rates. We are giving preference to the hospitals who are following medical protocols. They are charging the customers well. We are analyzing data to ensure that the readmission of customers is reduced, which helps in the customers as well as Star Health as a company. Lot of focus on data analytics. We are trying to manage frauds in a better way. That is giving it a lot of efficiency. So while there is inflation in the hospital bills, there are ways and means to ensure that, the customer is not impacted to the price increase. And we believe that there are a lot of claim efficiencies which will come in, which will ensure that, we are able to efficiently manage this whole inflation. To give one example of data analytics, what we have done is through predictive analytics, we have found out what are the high impact areas during epidemics. What we are trying to do is, we are promoting vaccination in these areas. So the customer does not have to get hospitalized, which will be very effective for the customers. So a lot of areas where the work is going on, and we'll ensure that, the inflation is not passed on to customers to the price increase.
So you don't think that's going to impact your claim ratios? Is that what you're saying?
No, so it will impact, but through the efficiencies that we are bringing in, the price increase we have taken, that should give us higher earned premium over a period of time. So we don't believe it should impact our claims ratio in the near term.
Tell me, as a trend, what is it that you see? You've highlighted the current price trends, but I don't think medical inflation is going to go away anytime soon, right? In fact, it's an ongoing upward curve, if I can call it that. So do you sense that more such price hikes could be in the offing, given the trend would be on the uptick? Or you can correct me if I'm wrong here.
See, that is what I'm trying to say. So though there is inflation, it is more so in the urban cities. When it comes to semi-urban rural areas, the impact is very less. And there are efficiencies which are still to come. The fraud control and management, it's a retail business. Any reports you see 8 to 10% is the impact of fraud. What we're able to identify is around 2.5%. There is enough and more work to be done. There are profitable products that we're trying to launch. Banca is a benefit product. So again, that should help us to reduce our inflation.
The other thing that I wanted to also talk about is that, what we gather from your commentary, or rather other competitors as well, is that 2/3 of the players in the industry are operating at a higher EOM than the guidelines. Do you see such a trend? And then what's the likely impact of this?
Yeah, that's a very good point. The regulator has brought in expense of management guidelines. We as Star Health are operating at 31%, which is well below the requirement of 35%. The objective of the regulator is very good. He wants that the policy holder should be benefited while the industry is, able to penetrate the market. So there are players who are operating more than 35%. What we believe is the regulator will give a glide path and ensure that these players start operating below 35% and continue to reduce expense of management. So that should be a good for the industry, in terms of reducing the overall cost of acquisition for the business.
And how do you plan to double the group business by FY24? What are going to be some of the levers, and are you on track?
See, when we talk about group business, there are two segments to it. One is the employer-employee, and we want to focus on the SME business, which is profitable, where the combined ratio is in the range of 93 to 95%. The other part of the group business is the banca business, where it's sold to the customers of the relationship PSU private banks. That again is doing very well for us. So taking both these things together, we want to double our group business, which will be profitable as well.
And on IFRS, you have to present your view by September of this year. What would be the likely impact? What's your view on what you think needs to be done?
Yeah. So what the regulator is trying to implement is IFRS and risk-based solvency. IFRS is basically a global standard which will align Indian accounting standards to the global standards. As a Star Health, as a health insurance company, we see that this will be extremely beneficial to us. Today, what it does is, the business is done on a yearly basis. So the earnings come over the 12 months period, but the cost of that business is recognized upfront. So there is always a drag for a growth-oriented company. What IFRS will do is it will defer the cost also over the earning period. So we have done some initial estimates, and we believe that our ROE, which is anywhere between 16 to 18%, it should rise by 2 to 3%. It should touch that 20% plus levels, and that's a direct benefit which we see due to implementation of IFRS. Along with IFRS, the regulator is talking about risk-based solvency. They have issued a technical guidance note on that. Again, for health insurance players, the weightages when it comes to RBC are very less. That again should release a lot of capital for the company. So both these things are extremely positive.
All right. Thanks so much for taking time out and joining in. That's the view. 20% growth is being aimed for in the near term. All-round growth and medical inflation, yes, is being seen in listed hospitals, but the price hike could perhaps mitigate the impact. That's Star Health quoting at about 615. But time to shift gears then. Metro Brands and certainly been making strides when it comes to how the business has been performing. But let's talk about the festive season a little bit more, what the outlook is when it comes to their margins. We've got Nissan Joseph, who's the CEO of Metro Brands, now joining in. Good to have you. Thanks so much for taking time out. Let's just discuss the kind of revenue growth momentum that we've seen, because in Q1, no doubt it has been a bit subdued. What is the demand trend really looking like?
Yvonne, welcome back, and thank you for having me again on the show. First of all, Q1, I think to say it was subdued is not a fair comparison. It really was a normalization quarter, so the previous year, there was so much pent-up demand, wardrobe refreshes, and not so much pressure on the discretionary dollar or the discretionary rupee on expenditures. Today, air travel is up big, restaurants are up big, vacations are up big. So, the discretionary dollar is being spent in more ways than it was spent last year. That is normal. So it really was a normalization quarter. So we really didn't see the subdued demand, although we did know we were lapping those numbers from the previous quarter. That demand trend has continued for us. We saw growth in premiumization products that were over 3,000 rupees. That climbed up to an all-time high of 44% for us. So that's one factor that we're looking at. We continue to see good demand across the sectors that we sell in. The other thing is we also know that coming into the festival season in the October period, a lot of the weddings that didn't happen in Q1 have auspicious dates in the October season. So we're seeing that as a condensation of wedding season dates and festival dates coming into October, November with Diwali, of course. So that also bodes well for retail in general. Underscoring all of that, of course, is the premiumization in India. The amount of consumption that goes on in bigger screen TVs than before, bigger cars than before, better Scotch liquors than before. I think that trend continues, and we see that also in our business. The good news, however, is also we're seeing it across categories and price points. So it is not just driven by a particular price point or a particular gender or a particular category. Overall, we feel good about the robustness and the spread of the demand.
Fair enough. I know you're talking about how demand is picking up. We are seeing a lot of consumer shift to higher end, people willing to spend. But at the same time, the margin picture didn't quite spell out this healthy projection of demand. So I just want to understand in Q1, what really hurt your margins? Do you think that a 30% EBITDA margin is going to be achievable for FY24?
Yeah. So, we've always guided with confidence about a couple of numbers there. One is that we would have our gross margins in the 55 to 57% range. It might blip up sometimes, it might blip down. Q1 blips up a little bit, Q2 blips down simply because of the end of season sale. But overall, we are very confident that we will achieve 55 to 57% gross margins. In line with that, we would have EBITDAs north of 30%. And I'm quite confident that we would continue to have EBITDAs north of 30%. Don't forget, we also have the Cravatex acquisition that in the first 4 quarters of the combination and consolidation of those numbers, it is going to have a negative impact on some of our numbers. But overall, the business is very stable and very sound.
The other thing I also wanted to talk about, Mr. Joseph, is on ground, how's the demand in tier 2 and 3 cities? Because when it comes to tier 1 cities and metros, clearly the tilt towards premiumization is evident. But is that the case in the smaller towns too?
Yeah, I think the portion of people that buy premium products is substantially lower in a tier 2 town, right? So we know that as a base. Once you have that base, Aisha, locked in, then what we do is look at the growth over that base. And, we don't see any less demands going on. In fact, I think one of my colleagues made a comment that their family wouldn't buy a luxury car in one of these tier 3 towns because they couldn't get it serviced. Notice it wasn't because they couldn't afford it, right? So it is evident to us that, the premiumization of India, the aspiration for better brands globally is across the tiers. And thanks to the internet and thanks to the proliferation of mobile phones across tier 1s to tier 4 cities, our consumers in our sector are very aware of what the global trends are and, have the same aspirations as people in tier 1 cities. There's just not as many of them, but they still have the same aspirations.
Yeah, absolutely. But tell me, what happens to your market share in the times to come? Because, along with an increased tilt towards that aspiration that you rightly highlighted, and across the board, there's also increased competition, right? Because there's room for many.
Well, I think competition is always good because what I believe competition does is it increases the size of the market. It increases awareness of your products and the awareness of, better products for consumers to have, right? So overall, I think competition in our industry, in where we are as a country, is much needed because it validates the sector. It creates high streets, it creates malls, and these are all shopping places and avenues which create more shoppers in the long run, right? So in a tier 3 town, if a high street became vibrant because there was a proliferation of global brands going in there with stores, that is really good for all of us. And the fortunate thing we have is in India, the population and the growth is so much that it is really not a zero-sum game. A competition opens up, so I can't grow. It really is an and game, that it's not a zero-sum game. It's an and game where we can all grow, and it's a matter of us in being available for consumers in markets, in real estate, that is accessible and exciting for our consumers.
Fila, what's the current status? How much of the inventory has been liquidated, and when will the new collection launch?
Yeah, so we're still through the process of working through the cleanup of inventory. As we've guided, we think it's going to take a good 3 to 4 quarters since acquisition. We're finishing up our second quarter roughly of the acquisition. So we know that this year, it is going to be a cleanup year. Next year is going to be resetting the brand, and the 30 is the acceleration plan. So it is going to continue to be a little bit of a drag on us. Having said that, though, I think we're also starting to see some exciting things happening with the brand as we look to the spring summer season, that we believe that will start setting the pace for the brand in the right way.
I wanted to know how e-commerce is shaping up for you. What's your average selling price? Is it margin accretive? Are you seeing traction there?
Yeah, I think the e-commerce business is, on pace. We had a great 60% growth last quarter in our e-commerce, so that continues, and we're excited about it. And it also has come at a time when brick and mortar has come alive. So we're not seeing a cannibalistic effect or a trade-off effect. So people aren't buying at brick and mortar instead of e-com. They're buying both places, which is always good. The margins of e-commerce are definitely distinctly different than the rest of our business. In India specifically, the e-commerce space is a discount space. And that is why, Yvonne, that we've never really pushed that pedal really hard, because it is not really as much of a full price game as we'd like. We do like the omni-channel business that we do, and it's 25% of our digital sales. We love that business because it is full price, but it is still a discount seeker. Having said that, though, we are distorting a lot of investments into the digital space, not because we want it to be about e-commerce, but we also know that the consumer is going to start their journey on digital and then end it in an offline era, especially when it comes to shoes. Shoes are really hard to buy online because the fit, it doesn't have much tolerance compared to a shirt. You can wear a shirt a little loose. You cannot wear a shoe a little loose or a little tight, right? So that has it. But at the same time, we understand that the consumer is digitally savvy and wants to start their journey at the digital space, which is why we distort and have focused our investments to ensure that we're digitally savvy when a consumer comes looking for metro brands.
All right. Really appreciate your time, sir. Thank you very much for joining us. Meanwhile, what do we have on the market? Markets are hanging on to that flat line, which is that the whole momentum in the market in the large and the small cap stocks, I think, is the missing part. You see, momentum can be on the up and momentum can be on the down. But the word momentum and direction is not there. And that is what makes the market very boring if you're looking at market purely from the prism of the Nifty. Last 1 month change, from the top you're down 600 points, which is frankly nothing on a 20,000 index. But what is important here is that mid and small cap stocks, PSU stocks, steel stocks, power ancillary stocks, all of them are literally on a tear now. SK Jha, CMD of Madani, joins us now. Mr. Jha, good morning. Thank you for joining us. Now, you are in the specialized steel business. You represent a company which makes steel for space, defense, and specialized steel utility. Could you first tell us that what are the demand trends in the specialized steel sector?
Yes, specialized steel sector is a good demand, as you have mentioned about the recent the development you have seen in the space in the terms of successful of Chandrayaan 3 and followed by further missions for the space, where we are already having a long-term supply orders, which we are executing right now. And we are expecting that segment will grow further. In addition to that, we'll also find the application of special steels in the area of defense application, especially, where you see that now a lot of program is coming, like in case of Tejas aircraft, also in terms of the missiles, different missiles are going to in the production stage. In addition to that, also there's a requirement of armored steels. So since Midhani is working in the special steels in the various segments, was very strategic in nature. In addition to that, some strategic platforms are also progressing very well, and there also we are seeing a lot of indications where the requirement of special steels are coming. So I see there's a lot of opportunities coming in the special steels. And when I talk about the special steels, it requires a lot of technological advancements, and where our company is regularly innovating in the area of special steels. And that is why we have a very good opportunity to enter in those segments. And you can see in the future, even the aerospace sector, also the type of emphasis by the government of India in increasing our presence in the aerospace manufacturing in terms of the defense is coming in the large way. And there also, again, the many new grades are coming for the special steels, where Midhani has the expertise. And we are already working on number of grades right now. And we see in the future, many new grades are also coming for the development, where we'll be participating and making our country Atmanirbhar in the area of special steels production for all the strategic requirements for the nation.
Mr. Shah, could you highlight in particular what your defense, what your aerospace order book is like? If you could just give us a sense of your order book as well as the pipeline segment-wise.
Yeah, first let me tell you in the order book today, what we are having is around 1600 crores order book we are having. In that, more than 70% is from the defense, and followed by another 20% coming from space sector. And in addition to that, we also have the export in the very low quantity, but is progressing well. But these requirements from the export sector is mainly for nickel-based alloys, super alloys, for which we have the expertise in making those grades. In addition to that, we are also a little bit getting involved in now again in the area of railways. So, and certain amounts also we are giving in the energy sectors. So combined together, we have the order book today. But as you have asked about the future, which you see the prospects coming up. So we see that many things are coming for, again, for the defense requirements, for the special steels, and also many opportunities which Midhani is trying to capture in the export market, where we see today there's a lot of requirements coming up from the leading aerospace and oil and gas companies of the world. And already we have done a very good initiation in this quarter, first quarter, and also I see in the second quarter also, where our materials have been given to the various aerospace agencies, and we have been qualified, which includes even the requirements coming from the SpaceX also, And also we are seeing the certain aerospace like Rolls-Royce also we have supplied some material. So these are the different opportunities I see where Midhani can take, means we have the requirements coming up in these sectors as far as the special materials are concerned. And last quarter, the first quarter, we had a very good order booking of around more than 550 crores order booking we had. And I am expecting that this quarter also we'll be having a good amount of order booking. And as we progress, we'll be definitely communicating to you that how much we are going to get the orders. But today I feel that order is not the issue, that how quickly we can execute and supply the raw materials, because today not only the production, getting the raw material from the different sources also is very big challenge, which we have to see that how we can fill that gap and make our customer satisfied with the timely delivery and right quality and also the right price.
Mr. Jha, hi, morning. Given that is a bit of a concern with the supply of the raw materials, there have been benign commodity prices though. Do you think your margins will sustain around 28 to 30%? And can we see a strong revenue growth on the back of strong execution and a healthy order backlog?
Yeah, in fact, if you see our EBITDA to sales percentage was last year, we have gone almost with around 35% we have achieved. So this year also we are targeting, but as I have mentioned about the fluctuating price of the raw material, which is a very one of the very important, I think component in our production. So we expect that we are trying to see that the possibility of maintaining in 25 to 30% we are targeting. It may not be 35, but definitely will touch up to 30% in our EBITDA to percentage sales ratio. This is our target, and we are trying to see that how we can achieve by doing certain process modification, technological improvements, yield improvement. So the various technological developments are taking place in our company, and with our team which is involved in the regular innovation and developments are working effectively. And that's why we are able to maintain. Last year also we have maintained. This year also I am expecting it will be maintained to that level of near around 30%.
Fair enough. What about the outlook then on emerging competition from the private sector entities? Is that a worry for the company?
It's always that there is a competition is there in the market, and it's good for the country also and healthy for the company also to grow. And we never see that as it's a challenge and opportunities both we are seeing in this. And today we are competing with the many, not only our domestic entities, mainly from the international market. If we are able to get the orders from the international market, it shows our the capability, efficiency in terms of the price, in terms of qualities, in terms of deliveries. I think that is where the measurement is given the confidence to our company that we can take the competition even from the domestic market also. And today I see the opportunities is good. So even though if our private sector in our own country, they are progressing, I don't see any problem in Midhani not getting the proper orders and opportunities. I think it is today its market is very good, and we have to capture the opportunities as and when it is given to us. And we have one advantage that we have our technological capabilities are very good, very strong. I think that is our main strength for which our company can take this type of challenges effectively.
Appreciate your time. Thank you for joining in, giving us your outlook on how business is shaping up, your export opportunity, as well as the upcoming orders. So the management is alluding to the fact that the supply of raw materials is a bit of a challenge, and the fluctuating raw material prices, that could be a bit of a constraint to margins. That's Midhani at 414. Tell you what, we'll take a very short break right here on the show. Be right back.